In here? We're watching you, Adolfo. We have names if everyone is coming in late. We've done pretty well at staying on schedule, so we're going to try to stay that way. Our next panel is on the global economic outlook. I had the pleasure and privilege of being in Basel 2 days ago for the National Business Economic Issues Council meeting. And 3 of the speakers from that meeting will form our next panel. Manuel Balmaceda, who's the chief economist of CEMEX, will be covering Mexico and Latin America. John Calveri, sorry, John, I'm tired. I got jet lag really bad. Calverley of Standard Charter is going to cover China, and then Kozo Koide of Diem, the largest asset manager in Japan, is going to cover Abenomics for us. So why don't you come up one at a time, and then we're trying to stick to 20 minutes each, and then we'll do 20 minutes of questions at the end.
That way I'll know when to stop. Okay, let me see. Oh, great. Thank you very much for inviting me to share some views on Latin America with you. Since we only have 20 minutes, I'll say everything I have to say in the introduction. That way, if I I can stop anytime, right? And I think everything I have to say is pretty much this title. It's Back to the Future 2, right? In other words, Latin America is at the same stage in a sense that it was several years back, right, where we're once again thinking about macroeconomic stability, reform agenda, sustainable growth, or whatever, which is the same things that we talk about it, external influence. And the question is now probably with a better setup so that, and a better mentality to really do the reforms that are necessary to move forward. And I will put the example of Mexico, which is one of the countries where that has happened and the reforms have been implemented. However, it's Back to the Future 2, because remember, in number 1, they went to the future. It's in number 2 that they went to the past to look forward. And in that sense, that's what we're doing, right? In the case of Mexico, what we have is we had a huge, and you'll see, reform agenda, spectacular. It really touches everything you can think of and a little more, right? And it has been passed, it's beginning to be implemented. The question is, when will it really impact growth, and to what extent, right? And the numbers are wide. But I would say the expectations on Mexico in particular, which is distinguished now from Latin America, are very high. But if you're expecting high growth in the short term, right, meaning last year or this year, don't. Growth will come slowly because some of the reforms are actually slow to really kick in, right? And we'll talk why. On the other hand, you have countries like Brazil in Latin America, which were the darling of the markets 3 years ago, and they probably overextended. And now they're in an adjustment process, and the only thing they have to look forward is the World Cup in the summer. And after that, we'll see what happens, okay? So just to give you an idea, this was Latin America in 2013, moderate growth everywhere, except for Peru. Peru and Bolivia are actually doing relatively well, over 5% growth. How about 2014? Same story. Moderate growth, Argentina and Venezuela in recession. There's 2 Latin Americas. It's hard to speak about Latin America as a whole. You have 2 Latin Americas or 3. On the one hand, you have the pro-market economies, among which I would say you have countries like Mexico, Colombia, Peru, Chile, right? You have countries which actually are, I wouldn't say anti-market, but it's close, it's as close as you can get, right? Such as Venezuela, probably Argentina in a different context, Bolivia or Ecuador, right? Although Ecuador is a strange beast, actually. They are more pro-market than we normally like to think, but it's okay. And then there's some countries in the middle, like Brazil, right? Brazil is never as good. I was saying this the other day in Basel, which is what they say in Brazil. Brazil is the country of the future, and it always will be, right? And that's the case with Brazil. It never grows as much as you expect it. They're very good at selling. They're great at marketing, but they're not that great at implementing. So they didn't use their expansion to implement all the reforms. So the question for Latin America actually is, will they be able to change this low growth, 2.5%, 3% growth tops, right, and become Southeast Asian countries, 5% plus growth, right, which is their aim. And that's the challenge. The environment for EMs is actually, in general, very tough, but in particular for Latin America. Latin America was one of the countries that was greatly affected by the global liquidity, right? The influx of liquidity in countries like Brazil and Mexico. Think about this, when we're talking about Latin America, over 70%, 75% of all Latin America is Brazil and Mexico, right? So in terms of GDP, markets or whatever, you're really talking about two countries and others, although some of the others are really interesting, but they're small or smaller. So we're talking about the impact of liquidity reversal, the contribution of China, they are producers of commodities, right? The political and geopolitical risks. Think Venezuela, think Argentina, or think elections in most of the countries this year, right? And structural problems. I would try to concentrate a little more in the latter part in the structural problems because the other three are outside of their control. It's something they're going to have to deal with, but there is little they can do really all they can do is manage the situation, but they cannot control how it develops, right? I would argue, however, that now they have buffers that they didn't have in the past, or that the buffers are somewhat better than they were in the past, particularly when we look at the external context, not quite in the internal context. First of all, external conditions in Latin America, it doesn't matter whether you look at our own estimations from the IMF, or estimations from CERES. In all cases, what we see is that external contribution to growth in Latin America has been always, even in recent years, very, very significant. It's been the contribution of global output growth, particularly commodity prices and international capital flows. Those two are the main drivers of Latin American growth, and therefore, the fact that those things are changing will have an impact in the region. And in particular, on the one hand, we have higher growth in advanced economies. That's one of our assumptions, and therefore, that will impact Latin American economies positively, particularly Mexico and Central America. And also, we have, I like to call it normalization in high-income countries. I don't know whether monetary policy will ever normalize in Japan, or what's going to happen in the ECB. The only one in which we have some forward guidance is in the US, and I don't know whether normalization is the right word anymore. It's just slow. But in any case, what this is doing is obviously reducing the flows into Latin America. The flows are returning back to developed economies, not only, because here I'm saying only monetary policy. Actually, there's something that is probably more important than monetary policy in the term of the flows reversal. Is the fact that the European periphery, or that the breakup risk in Europe has disappeared, which has meant that a lot of flows have returned to Europe, and particularly they have returned to the periphery of Europe. Right now, and we were talking about that yesterday, the 10-year rates in Spain or Italy are below 3%, the lowest they've ever been, right? Or the 5-year rate in Spain is lower than the US's, which is something to think about. But in any case, how does this impact Latin America? Obviously, the most financially open economies will suffer higher impact, or should, or could. The last one is the accelerating growth in China. John will talk about China later. But to the extent that China is decelerating and having lower demand for commodities, right, that should impact those metal commodity exporters, particularly Brazil, Colombia, Peru, Chile. So the story for Latin America is going to be very different depending on the impacts of these different drivers. And there is one more factor which is important, is the fact that both financing conditions and commodity prices, we have to distinguish between the part that has been a structural change. There's clearly a structural change in commodity prices. And there has been a structural change in financing flows to countries like Mexico or Colombia because of the reforms. The question, how much of that was structural, how much of that is cyclical or transitory? And to the extent that they are structural, the impact will be less. Okay? In any case, I will just focus on a few. The first one is obviously monetary policy in the US. I will not get into which one of these will be. I will assume that everything is done correctly, that the Fed does everything correctly, everything works. But even in that case, there is an impact on emerging economies, right? And there's an impact on emerging economies, and we saw it already, because the moment that the policy of tapering, that tapering was announced, not when it happened, when it was announced, there was huge volatility in exchange rates. This is something very similar to what we saw earlier today. It's not what matters is the announcement. You know, markets react to announcements. When the policy is implemented, actually, in some cases they corrected, in other places they augmented, then other factors came into play. But the initial factor was actually the announcement. So tapering did have an impact. When Bernanke announced before Congress that tapering would start, that's when the flows to Latin America begin to fall, right that moment. Actually, when the official tapering announcement was made, nothing really happened. Flows continued to exit or enter depending, on market sentiment. Actually, they went quite down in the middle of last year, then they picked up a little bit, and they're still there. Because at the end of the day, there is a concept which is clear. If you remember, Treasury Secretary Conley a while back in the 70s, right, has said something like, it's our currency, but it's your problem, right? Now it's not your currency, it's our QE, but it's your problem. In other words, US monetary policy will not take into account whatever happens elsewhere, as they shouldn't. It's going to happen regardless, and countries will have to adjust. And this flows to the region, these smaller flows to the region will have an impact because some of the vulnerabilities which are in the external sector are associated to over-leverage, higher indebtedness during the crisis, and whatever. I will not go into each one of those individually. If you want, I will later. I have the graphs here. I just want to show you this map, in a sense. What I want you to see is, if you look, this is Latin America, and this is external vulnerabilities. When you look at the external vulnerabilities of the region, it's true that the current accounts have actually deteriorated significantly in all of the region. So most countries in the region are actually vulnerable to current account. But the reserve coverage, which we were talking about earlier about Poland, is actually quite good. They all have increased significantly. You saw the chart. Actually, Mexico has much higher reserves and having a flexible exchange rate than Poland. There is no problem. External debt, actually the external debt is quite low, and particularly debt in foreign currency is lower than it was, particularly public debt. There is some issue which we can talk about private debt in foreign currency. But that's also matched with assets in foreign currency, right? And therefore, or partly matched by assets in hard currency, and therefore the impact of excessive depreciation would be smaller, and particularly the impact on monetary policy, which is what people are worried about, shouldn't be as dramatic. But what the vulnerability chart shows us is that actually the most important part is the domestic vulnerability. In particular, you have countries like Brazil, Argentina, or even Chile and Colombia. They had excessive credit growth during the boom, right? If you like the BIS type of financial crisis indicators, this would be your primary indicator of trouble to come. Therefore, the adjustment is there, it's going to happen, and it's happening in the domestic sector because of that. That's not the problem in Mexico and Peru. The fiscal positions are actually not as good as they should. They all have deficits which are higher than they were in the past. You might say, oh, but Latin America, they're growing economies, they're emerging economies, therefore it's not too bad that they have a small deficit. The problem is they had a huge, let's say, injection of flows, and they had a structural change in terms of trade. And all the commodity receipts, if you want, they wasted them in a lot of cases. Pretty much they spend them, and they haven't put them to good use. They still have huge deficits. And the last one is private debt growth. And those domestic vulnerabilities is what might worry us going forward. It is true, I said there were buffers, and when you look at Latin America in the region, with the exception of Argentina, which is red all over, and Brazil, which is yellow across, right? The rest, with the exception of exchange rate flexibility, which only Chile and Mexico really have a flexible exchange rate, the rest of them have a managed float, right? The rest of the indicators are actually quite good. Both monetary policy is independent. They have very decent central banks, which are quite independent. They've raised rates in the case of Brazil or Colombia for different reasons, but they both did. Inflation is under control everywhere, and their structural public balance is not bad. It's okay. So, I mean, they have buffers which are much better than they were in the past, so one wouldn't expect a crisis in the region. So there are two things. On the one hand, we have in these internal factors, we have the macro management. They have policy room. And in this case, the macro management has been much better than it was in previous crises. Really, with the exception of Mexico, Latin America did not suffer a crisis. It was a little bit like Poland. Actually, the crisis was not there because what went bad in the rest of the world did not happen there, and they got the benefit of the excess liquidity the global excess liquidity. Therefore, that mitigated the negative impact of the lower trade and lower other impacts, and actually growth was pretty good. In particular, in countries like Brazil, it was the highest it's been in decades, right? And their macro management did improve in the region. However, in terms of structural reforms, that's what they're lacking, and the short-term risk is elections. In terms of structural reforms, I would say the problem is not a problem of diagnosis. We all know what the problems are. I mean, the reforms needed are very well known. It's a question of implementation and political will to pass them in most countries, right? And to the extent that they didn't use the expansion to introduce the reforms, what will make them introduce them in the recession, right? The problem with the structural reforms is that it's never a good time to pass them, right? In expansion, why would you pass a structural reform? You don't need to. Everything is looking great. To get all these flows, you don't need to pass the structural reform. In the bad times, gee, you don't want to do a structural reform because it's costly, right? And particularly, it's costly politically. So that leads you to think that it's never a good time to pass a structural reform, when the truth is there's always a good time to pass structural reforms. In the case of Latin America, you have countries like Brazil who found that it was never a good time to really pass deep reforms. I'm exaggerating. They did pass some reforms, much more than they had in the past, but not enough, right? Or countries like Mexico, that in spite of the recession, decided they would pass reforms, right? You might ask me, one of the things, obviously, and I will skip this is on education. In education, I will just say one thing. When you look at education, it doesn't matter where you look at GDP per capita. Education reform is one of the key pending reforms in Mexico. When you look at Latin America, it's the yellow dots. All of them are down here. When you look at GDP per capita and PISA scores, Latin America doesn't do very well. You say, but this GDP per capita is not a good measure. How about expenditure per capita? It's bad. Even for higher expenditures, they don't get the PISA scores. I would counter-argue, and yesterday at the OECD I got in trouble for saying this because they produce PISA, so they don't like people criticizing PISA. But I would argue that it's much more interesting to have productive knowledge, right, which is the Hausman and others at Harvard have produced this measure of productive knowledge, and what they do is what is the export content or the productive content of the human capital in your productive structure. Because there's externalities to that. Therefore, that's much more interesting to see where growth will be down the line, because this is closer measure of human capital than PISA. PISA is education, pure, straight education results in mathematics or whatever. This is your productive capacity. And in that case, countries like Mexico are actually, because of their diverse economy, they have, as you know, very natural products. They produce oil and export it, but they also produce cars. They have a very diverse economy and a large export content. They are much better positioned than countries like Venezuela or Nicaragua or even Chile. Chile is the darling of the region, right? It's always said that Chile is the right country in the wrong neighborhood. However, in terms of productive knowledge, they don't look too good. And part of the reason, and I like the way Hausman put it back when talking to him, he said, look, Chile is great. Nobody's complaining about the macro policy in Chile, but in terms of productive knowledge, as adopting technology, they're not that great. They've been an exporter of commodities forever. They still are. They're the largest producers of copper in the world. They're one of the mining giants of the world. However, they have never gone abroad and bought a mine. Instead, they still need resources to mine their mines, so they haven't learned how to do it. Right? They are not any more competitive than others in mining, which is their primary productive source. So in terms of productive technologies, they're not that great, right? It's anecdotal evidence if you want, but it's got a very interesting component. It's like, look, if you know what you're doing, you will expand your economy, and actually you will expand your production elsewhere. And that's something, for example, Chile hasn't done, and Mexico has. Cemex is one case in point. The other one is, I know I talked a lot about Mexico, and you say, oh yeah, first of all, that's one of the requests, and I said they did a lot of reforms. This is the list of reforms that Mexico has passed in the last 3 years. Labor market, local state accountability, education, telecom, electoral, political reform, financial banking, fiscal reform. Although fiscal reform is a very small, they will have to do another one because it wasn't enough. All they got is more revenue, and that's it, right? And particularly the last one, energy reform. So they were very, very adamant about reform. They spent all their time doing reform and little else. Growth was very low. But still, with all these reforms, eventually, it should pay out. Why do I say energy is important? This is the energy price, the electricity price for small industries, in the OECD. Norway, the US, down here. Mexico, which is an oil producer, natural gas, supposedly reserves very, very high, has an electricity cost similar to Poland or France. They are wasting one of their key advantages, or one of their key competitive advantages, or they are not exploiting it. As a matter of fact, they're losing, or they might lose industrial base to these guys, to the US, okay, to the guys right up north. And in that sense, the energy reform in Mexico is the one that will really add to growth. First, directly. Obviously, you are going to need exploration, you are going to need investment, and so on. But second, and I would say even more importantly so, indirectly, right? Companies that are now settling in the US, petrochemicals, could easily settle in Mexico, cheaper, with the same gas prices. Or the industrial base at those electricity prices would be much more productive in Mexico without a problem. So the first part of the reform really is trying to get gas from the north into the south more than exploration, right? And you might say, okay, why is energy reform so important? I will tell you something. I mean, the most important thing in Mexico with respect to energy is that all oil resources belong to the state. To be able to change this, you needed constitutional reform. Mexico had to change the constitution to be able to have foreign investment in Mexico, in oil. They did that already. Now the question is the law and the regulations, and that will take time. Other of the reforms which was very important was however, with these reforms, what do you expect with growth? Obviously, growth will not happen overnight. It will happen slowly. As a matter of fact, I would argue that probably a lot of these reforms have a cost in the short term. Let me give you an example of the one that has the least benefit in the short term and probably one of the most beneficial in the mid to long term, which is education. Mexico changed their educational laws for two things. First, to make it more competitive, but second, not only grading or testing the students, but you need to test the teachers. Now, teachers, which are public servants, and you know public servants, those in the US don't understand this too well, those Europeans they understand very well. A public servant is there forever, for life. You cannot fire it. You can't do anything. They changed that. If they don't meet certain goals and certain tests, they could be fired, right? What would the impact of this be in the short term in terms of education? Zero. If anything, negative. First, you're going to have less motivated teachers in the short term, and second, the teachers took Mexico City. Literally, there were strikes, protests every day in Mexico. In the short term, you have a negative cost, negative impact. In the medium to long term, that might be very positive. So in that context, all these reforms have to be thought of in a medium-term perspective. And the last part is, for Latin America in the short term, is elections. As you can see, there's elections pretty much everywhere, except for, obviously, Venezuela doesn't have elections. We don't know when there will be elections in Venezuela, or if there will ever be elections in Venezuela. And Argentina. No? Actually, somebody yesterday at OECD mentioned that actually there were elections in Argentina. That might be a positive risk, not necessarily a negative risk, right? Because the outcome might be, whatever outcome they get is probably better than what they have right now. So that's a different story. But you do have elections in Panama, Colombia particularly, although things look straight, and most importantly of all in Brazil. So Brazil is going to have a tough year. Brazil has World Cup in the middle of the year, right? We don't know whether they will be able to finish the construction or whatever for the World Cup. They have a lot of water problems, electricity problems. It's not going to be a good moment. And then they will have elections in the fall. So they're just going to keep kicking and feeding the pipeline for the next 6 months, no matter what. But then what? That's the question in Brazil. What is the outcome afterwards? Brazil and Peru are the two countries that don't have elections. They're feeling confident, and they're looking, at least for the next 2 years, better. The only problem with Mexico is actually up here, right? To the extent that the US never grows at the rate that we all think is going to grow. Every year we think it's going to grow around 3%, and by May we say, maybe not 3, maybe 2, right? That has a huge impact in Mexico, because Mexican economy is very, very closely tied and very closely linked to the corporate sector in the US. Sorry, the Mexican economy is very closely tied to the corporate sector in Mexico. The best indicator for Mexico, actually, or one of the best, is the ISM in the US. Right? So those are the main risks. How important is growth? And this is a little bit, graph that I show kids, right? Because it's very, very graphical. It doesn't say much. This is the growth that Mexico has had historically, 2.7%, right? Booms, bust, 2.7%. It doesn't matter which period you get. It's around continuing the trend, right? Right now, most people project that growth in Mexico probably can go between 3.5%. That would be adding the GDP of Switzerland in 10 years. So cumulative growth of 1% is tremendous, right? What about if the reforms had an impact? According to the studies done in Mexico and outside, the reforms could add anywhere between 1%, our estimates is a little bit above 1%. Estimates in Mexico, in the Hacienda in Mexico, in the finance ministry in Mexico, go between 2 and 2.5% points, not 2.5% growth, 2.5% higher growth to their historical growth. So they are thinking that growth could go 5 to 5.5 to 6%. What would that mean? That would mean with 5% growth that you could have the equivalent of Italy in 10 years. If Mexico were able to grow 5%, that would be impressive. And the nice thing about Latin America is that they have the population. This is the long trend that we never talk about. Population is not a problem. They have a young population. They still have their population dynamics very favorable. So in that context, they got the potential. So it's back to the future. Mexico, Latin America, there is a region with huge potential. They got the population. They got the resources, right? They now have the capital. When will they grow, right? It seems like Mexico is doing the right thing. I would say Brazil didn't. There are countries like Colombia, Chile. The latest trends in trade between the Pacific Alliance is called, between Chile, Colombia, Peru, and Mexico is a move forward. More liberalization. It's moving in the right direction. When will all this pan out? Hopefully not in that long term. But, at the end of the day, this is just a map, right? If you think about it, most of what was US was Mexico not that long ago, right? Latin America extends down here. But when we do all these projects, you think that from Florida to California, you need a boat, right? That's not the case, right? So at the end of the day, all these projections that we're doing, they are without shocks. And the only thing we know is that we're going to have shocks going forward. And the question for Latin America is, how do they manage shocks in this context? I would say there are countries which are much better prepared to adjust to coming shocks, right, than others. And that's the key, and that's what we have to keep in mind. Thank you.
Thank you very much for giving me this opportunity to make a presentation in this gorgeous room. Before touching upon the gloomy economic data of my country, let me touch briefly upon my family episode. My grandfather lived in this country more than 100 years ago. I should say in Scotland, but he was an engineer to learn the shipbuilding technology. At that time, the UK was the ally of my country to beat Russia together. And at that time, without no doubt, the shipbuilding high-tech, and this is the best country to be for him. And 100 years later, I just enjoyed visiting London, Scotland, because here maybe I can enjoy the most intellectual person in the financial industry. I'm sorry, the American friend from the Wall Street, but a much more highbrow person is working in the financial industry. So therefore, I respect the financial businesses in the middle of, I would say, in the city, to quote my episode, the episode of my grandfather. Just the GDP, weaker in the fourth quarter. I just keep refraining from getting into too much detail, but I could not believe this dismal number. Maybe there is some misalignment to figure out the inventory, so therefore maybe second quarterly estimation will be upward revised. But regarding the GDP, the main focal point is the first quarter of this year, before the VAT hike. And before I just go through the first quarter of this year, I myself expect maybe the surge of the personal consumption before all the tax hike is not too large, because after the Lehman shock, we incentivized by the measurable cashback for the purchase of the durable goods. That was one is the new car, the other is home appliances. 3 items was targeted after the Lehman shock. That was the washing machine, the TV, air conditioner, and refrigerator. So therefore, we already bought a new one much in the last 4 or 5 years. So therefore, there's no pent-up demand. But something happened in March. The left chart is the retail sales value index. Of course, this data is inclusive of the demand from corporate side, so therefore not purely the consumer side, but still the yellow part and this blue part is very eye-catching. The yellow part is miscellaneous something, mostly the very expensive watches and jewelries and bags and shoes, and this part is home appliances. And this is the propensity to consume, average propensity to consume, employed person hit its highest record since the 1977. Maybe there is a serious sampling bias. This household survey has only 8,000 sampling, so therefore we will have another data set to have the double sampling scale in a week time, but still there's something, and including the fishermen and the farmers, although which has the shorter duration of history since the year 2000, that was also 107%, more than 100% disposable income was purchased in March. So you may worry about the dip in the second quarter of the GDP, but rather I say people's mindset to buy something before the tax hike. So therefore, just what shall I say, the sentiment to not too much worry about the future life standard, the income, just lower, and the people is easy to buy these days. And the first week of this month, the Nikkei newspaper, the leading newspaper, did the fairly comprehensive opinion poll regarding the VAT. 66% of the answers says no change level of the spending after the VAT hike. And also the 52% says maybe this time around the VAT hike is good thing rather than bad thing, which was the 32%. So therefore, there's a lot of economists sitting here, so we should remind the non-Keynesian effect this time around rather than Keynesian, Ricardian effect. And I don't want to get into the detail about the 10 points. I did not too much worry about the VAT hike this time, but among others, I should just emphasize the point 9, money illusion theory proposed by the Dr. Irving Fisher in 1928. The left chart is the propensity to consume. The blue line is a propensity to consume, and the blue bar is a nominal disposable income growth from the previous year, and pink bar is real disposable income growth. And when I was assigned for the macro research for the first time in 1992, there is no word of deflation. We call it price destruction positively. Why don't you worry about that? Even if the nominal income growth is decelerated sharply, unexpectedly, but on the other hand, because of the happy price destruction, not the deflation, the growth of the real income is not too bad, so don't worry too much about the real consumption. But in reality, the propensity to consume continued to go down till 2002. This is what I am talking about, the virtualized mindset or propensity to consume or degree of the wealth image of the ordinary people walking on the street is heavily governed by the nominal dynamics rather than real dynamics. And let me put it much more simply. Our conventional model using the real figure or everything. And if you have 1% inflation together with 1% nominal income growth, there's no change in real-term income. But on the other hand, opposite side, 1% deflation and 1% decrease of income. Also, there's no change of purchasing power. In a conventional model, there is no generic difference between the two. But if you are asked by someone that which would you like to choose, no real growth in the real income, but which would you choose, 1% growth of the nominal income or 1% cut of the nominal income? I believe that 100% person answer that I will be happy with the nominal growth. So that I'm talking about under the name of the money illusion. This time, there is some moderate inflation, 1.3% is the core CPI inflation right now. And the nominal, of course, there's some moderate nominal income growth from the last summer bonus time. So therefore, real income growth sluggish, lower than the nominal income growth. But propensity to consume just hit its bottom, and this is a historical high, the propensity to consume. And also, this is another episode talk about the positive side of the consumption. This is the diffusion index of business sentiment surveyed by the BOJ every quarter. We are getting used to see the large companies' diffusion index on the newspaper. But this is a small businesses sentiment, non-manufacturers. And my senior colleague taught me that this is one of the good indices to gauge the business conditions close to the personal consumption, because the share of the papa and mama shop in the retail house is very high. And when I was assigned for The Economist, February 1992, that was go to zero. And throughout the last 2 decades, this diffusion index moving below the watermark. But finally, there is upturn momentum, a positive figure 2 quarters in a row. And if you see when is the equivalent phase to see the negative to positive upturn, that was 1987 at the first stage of financial bubble in my country. And labor market has tightened up. This is labor demand supply situation diffusion index. Diffusion index is the numbers of the corporation who says that we have a slack of labor minus the numbers of the corporation who answered we have a shortage of labor. And now come down to the minus, I remember, 12. That was the almost lowest figure, again equal to the 1987. So therefore, majority of the Japanese corporation is now pretty much annoyed by the serious shortage of the labor. Third time since 1988, and 2007, and now. And this springtime wage hike rate is here, highest in the last 15 years. And if you look, if you see this red line, this is a diffusion index of a capital stock. So therefore, there's no capital slack at all. Come down to 0. So therefore, diffusion index for capital is 0, and diffusion index for the labor is minus 12. Why don't you argue that still our country is annoyed by the deflation gap? That's nonsense. So therefore, if you have some question, I'm happy to answer after my presentation. It's a little bit technicality, but I believe the approach we have to gauge the deflation and inflation gap by the Cabinet Office economists is utterly wrong, and we have inflation gap here in Tokyo. So therefore, because of that kind of inflationary pressure, push up the propensity to consume since the last year. And cautious, a caveat is a capital expenditure. Like in the United States, very weak and somewhat weak. And this green line is the, I call it expected return on investment, gap between the return on asset and weighted average cost of capital when I put the 4% as the equity risk premium. And suppose the marginal return on asset is equal to the marginal average return on asset. Right now, the expected profit from the marginal capital expenditure is highest, more than the record high in the Koizumi reform era. At that time, we enjoyed double-digit growth in the capital expenditure, but there is no growth. Very strange, but I think this discrepancy cannot sustain, and there is something, there should some positive sign in the investment plan for this fiscal year. This is a capital expenditure plan, again surveyed by the Tankan survey by the BOJ. And I exclude the investment in real estate and included the software investment. And this upstream kind picture is March, June, September, December, and real outcome. So therefore, every quarter's figure of the capital expenditure, how much would you like to spend for the capital expenditure compared to the level of the previous year. So when there's upstream of the business cycle, this growth tends to accelerate it throughout the fiscal year. And in the downturn, these charts tends to go down the downstream. And all size, all industry basis, the July figure is not too encouraging, the same. But if you take the much more factual, I say, the corporations are clustered to have a much more concrete plan supported by the organizational discussion inside the company. So I just look at the investment plan excluding the small businesses. Finally, there is something happening is, for the large manufacturers. It's supposed to be stimulated by the overseas economy together with the cheaper yen. But until recently, the investment is too sluggish. But the investment plan of the large manufacturers as of June is the highest since year 2007. But before talking about the capital expenditure, another caveat is very weak export. My colleague Kathleen touched upon the elasticity of the import and export of the United States in the morning session. I did the same kind of approach. Suppose the real export, or I may say the real export volume, is governed by the two factors. One is overseas economy demand. I took the global indicator or global leading indicator of the OECD, including the 6 emerging economies as a proxy. And the other factor is real weighted average foreign exchange rate of the yen. And suppose the relationship between the exchange rate and the export volume and relationship between the overseas economy and the export volume stay at the same condition before the Lehman crisis and exponentially extended the model, and the Japanese export volume should have larger by enormous 40%. So therefore, the adjustment of the high yen began in the autumn is 2012, but 18 months have passed, but still the reaction of the volume of the export is very, very low. Well, one of the reasons is this time around the Japanese exporters did not play dumping. We are accused by the cutting aggressively the retail price in the US market when there is a cheaper yen, but not this time. This is the nominal average exchange rate. At the peak, there is about a 24% depreciation from the previous year. And almost always the case, this blue line is the export price in the local currency. So therefore, that means if there is a 20% of the depreciation, Japanese exporters cut the price by the 20% to enlarge the market share in the US market. That was a common behavior we have been seeing in the past, but this time, there's no change. So therefore, Japanese exporters much more cautious about the profit margin rather than market share. So therefore, it's not too bad thing to just look at this kind of generic differences. But much more worrisome side is the value, additional value added of the Japanese export become very low after the tsunami. Right chart, we have the two sets of exporting price. One is a quality adjusted one. The other one is not quality adjusted one. This red one is quality adjusted one. The BOJ just check out the exporting unit price of the export in the same commodity mix pegged as of 2010. There's no adjustment. The other one is price index of the MOF. There's no adjustment of the quality. So therefore, when the Japanese exporters transfer the manufacturing line out of Japan to some Asian countries and replaced by much more highly valued export from a city of Japan, this price just can go up. So therefore, the dynamics between the two, I name it proxy as a value-added index. But you see, they become very flattish since the tsunami, and these two lines dancing together in the last 3 years. So therefore, we just, it was very, very painful us, not only from the downturn of the sudden plummeted global economy outside, but also after Lehman shock. Please remember, we have suffered the sudden, extremely rapid appreciation of the yen, among other countries. So therefore, a lot of Japanese exporters just hollowed out. And after the tsunami, there is some substitution effect by the overseas the production and transplant. But that kind of, what shall I say, to go out, but there's no innovation inside Japan, that kind of dynamics could not go on. This is not just sustainable. And without no doubt, if we would like to elevate the level of the quality of the export, we should invest something inside Japan, much more high tech-oriented research and development, extensive investment. But I see there's some measurably positive sign I can witness in the latest quarterly survey of the BOJ. And inflation, 1.3%, and higher than expected by the board members of the BOJ. The average core CPI during the fiscal year starting this April is 1.3%. So therefore, before getting into this fiscal year, already the consumer product was inflated to the targeted inflation rate for this fiscal year. So therefore, it is very hard for current BOJ board members to take another step ahead to expand the balance sheet, because already we have inflation. Because we do not targeting equity price, rather we are talking about the inflation rate. And the important thing, finally, we have some moderate inflation, and the demand-supply situation of the JGB market heavily supported by the QE by the BOJ. So therefore, finally, in the last decade, we have measurable negative interest rate. In US and Europe, the real interest rate is going up, but the other way around in my country. So we have a lot of cash everywhere in corporate balance sheet, in household and institutional investors. So therefore, before talking about the efficiency of the third arrow, namely that was a growth policy, why don't you look at the dynamics of the inflation? What the inflation would just deliver as some structural change in the balance sheet of the players. This is a cash divided by the sales in a macro term, hit its highest record, continued to elevate after the Lehman shock. And this is a cash. There's no real return anymore under the inflation, the negative real return. So therefore, the corporate manager should do something about that by nature. And suppose if this is too high, and suppose if this cash turnover ratio is come down to this level, the fourth quarter of the year 2007, before the Lehman crisis level, the 37 trillion yen cash will get out, just get out from the cash balance off the balance sheet. And this is equivalent to 54% of the total capital expenditure in the last fiscal year. And this is a portfolio rebalancing of the household. The household already just liquidate the cash balance and put their money in the investment trust or something. And the red line is I define the risk exposure to risky asset. Here I define the investment trust plus domestic equity and foreign securities going up. But about 50% of the inflow and outflow of the cash and inflow to the risky asset is concentrated in the pension and insurance or some annuity program. And that was the allocation of pension. Aggregated inflow and outflow of my clients. It's sorry to say that they are very much cautious and behind the curve mode moving. And this is a 4 quarters summation number. So therefore, this bar is the total inflow and outflow of the Japanese private pension in the last year. They continue to liquidate the foreign denominated asset. They continue to sell the domestic equity. They continue to buy the JGB, and they continue to put their money in the cash account. It's absurd under the inflation. So therefore, there should be some rebalancing after the inflation. Once the pension manager understands maybe the deflation is over. And this quarter, there is structural change by the government initiative upon the GPIF, the largest institutional investors in the world, government pension investment fund. More than 90% of the board members are just changed, including the chairman. And I believe that from this quarter, they just began to reallocate the exposure to JGB into the risky asset bit by bit, and other Japanese private pension will follow. I said blind followers. And I would like to stop that because of the time constraint, maybe. Because if you ask about something about the growth policy, I'm happy to answer. But if you have, can I have, how much, Mike? Maybe I should stop here. Maybe. 5 minutes. Well, the next panel discussion, one of the panelists was Mr. Rory Hallowell of the UBS, and I was invited from the UBS, the annual conference in London in last November. I was one of the person on the booth side. But a lot of participants criticized the growth policy, but did you ever read every pages of the growth policy already released in the just June? It was more than 300 pages in English. It's unfair to criticize the growth policy without reading nothing. Only they read the articles of Financial Times. So this is not the kind of chatting in the barber's shop, I said. But anyway, I cannot put the full mark of the current growth package, but there is still something. Oops. And tax incentives of the scrap and build of the capital stock. One of the reasons why a lot of major Japanese corporations just wait until this registration, because there's a huge additional tax incentives to corporate spin-off. And right after the registration, the Hitachi and Mitsubishi just joined together in the thermal energy project. And also one of the big reasons why the capital expenditure number was so sluggish within the last fiscal year, because the new tax deduction will enacted by the new law starting this fiscal year. So therefore, maybe there is some arbitrage between the to just use the lower VAT hike to use the new machine, or wait until the new registration or tax rebate or 100% upfront depreciation grant by the tax authority starting this fiscal year. So therefore, this is one of the reasons. And labor management. One of the agenda of the previous session is the flexibility of the labor management. And the central bankers of Poland says that the temp staff ratio is high. So this is the competitiveness of the Poland economy. But our labor law is a little bit unique, and after World War II, first initiated by the GHQ policy of the United States, heavily guarded by the Constitution. It is no right for the manager side to fire the people. It's quite limited. So therefore, there's a huge, of which I very much, too much protected the ordinal labor. And there's a temp staff. And this is the temp staff contribution of the labor growth divided into temp staff and the ordinary labor. But you see in the last almost decade, almost all of the growth of the labor supply was a temp. So there was a huge disparity between the right of the labor in the temp side and the ordinary side. So therefore, this government makes some in-between status by the deregulation. I could not touch upon precisely. There are some notes on that, and you can read that afterward. But in short, for example, my company, once they employed the temp staff, and 3 years later, if the temp staff program will extend it the 4th year, the government requires us to hire her as an ordinary staff. So therefore, almost all of the case, we should just kick back her to the staffing service company. But this legislative change put pressure upon the staffing corporation side to employ her as their own ordinary workers. So therefore, in the future, maybe the Toyota or Honda cannot hire the much ordinary people, but the large, powerful staffing service company can hire some engineer dispatched in a Honda, Toyota, or Nissan, wherever, by the ordinary employment staff. So therefore, the pressure just shifted to the temp, just the stuffing side. And there's some female audience, so therefore I'd love to touch upon the nursery care station system. I'd love to, but maybe I'll skip that. But finally, these days, let me put this. When I visited Dubai last year, one of the Middle East businessmen told me that, "Are you Chinese?" No. I'm not Chinese. Then you must be Korean. No, I'm not Korean. So therefore I said to him that 15 years ago, maybe you must have asked me that, are you Japanese? So therefore there's an image of the high-tech country get rusted, but so therefore I just give you some sense of high-tech of Japan today. Still, the Japan is a wonderland of the high-tech. American people know the Google auto-driven car. And I've heard that the chief engineer of this project was a spin-off person from the Toyota. And this robot, the Shaft, this is the robot developed by the venture business in the Tokyo University and won the first prize of the DARPA Robotics Challenge. DARPA is the Defense Advanced Research Project Agency of the Pentagon. And already the Google also bought this robot, so therefore maybe this robot will some prototype for the future, what shall I say, robotic soldier, something like that. And this was impressive. This is the automatic machine to support the, what shall I say, the arms and legs who was suffered by some, paralyzed by the disease. And even if the, your leg was paralyzed by some disease, still you can think that I would like to move my leg. And one of the skin sensors just read the order of the brain, from the brain. And even if the leg was 100% paralyzed, this machine just helped to move up the leg. And this machine already get the license in the EU. And now the Germany is just covered by the government health insurance policy. And German government paid 300 euros for the 3 months care supported this machine. But the problem is this machine is not get a license in Japan. That is something we'll worry about that. So therefore this is the, I should cut. And right chat, maybe some of the, my friend visited the US San Diego. US San Diego is the center of the high-tech medical technology. This is the Da Vinci. The first developed the high-tech remote robot for the surgery, the Johnson & Johnson. And $3 million US cost, and already there's 150 machines in Japan. There's no equivalent robot in Japan. So that I came back from the San Diego and asked my business contact why the Japanese top-rank robot makers did not try to develop this kind of machine. He said, this is heavily regulated by the regulation of Ministry of Healthcare. And if the, he said, Japanese competitors will allow to make that kind of machine, maybe the manufacturing cost is less than 1/3. So therefore, still there is a lot of things we should deregulate to incentivize the business innovation. But here today, my punchline is please remember that generic big differences between the inflation and the deflation, and there's a huge cash. And once we get into the inflation for the first time in the last 20 years, there was something will happen unexpectedly. Thank you very much.
Well, thank you very much for this opportunity. So I'm going to try and make sense of what's happening in China. And that presents me with at least two difficulties. One is the data. As you know, somebody once said, paraphrasing, that there are lies, damn lies, and Chinese statistics. And I think that's unfair, actually, in a way. The data has improved a lot. There's now a lot more data than there used to be. But I will nevertheless argue that some of the data that is produced is actually, if anything, exaggerating the problems that China has. So it's not all presenting a favorable view. So we have a slowdown going on, and I see it as a policy balancing act. How do you slow the excessive growth of credit, reduce the investment ratio, because we all know that is too high, although I'll talk more about that in a moment. How do you implement a very ambitious reform program against vested interests? At the same time, how do you maintain reasonable economic growth, and particularly the employment market, because I think that's key. And I would argue that above all, you want to avoid the middle income trap. So what I'm going to do is to run through some of the recent data, try and look at where we are, and then I'll talk about some of the structural issues that have to be dealt with, in particular this investment ratio and credit. And I should say, coming to the second big problem I have, the issue is there's a huge range of possible outcomes for what's going to happen in China over the next few years. It's very easy to tell that bearish story. There's too much investment, there's too much debt, that it's going to end in a financial crisis, or just investment is going to slump all the way. And I can't rule that out. That is a real possibility, I think. A lot of countries have been in this situation and things have gone wrong. I'm going to argue that you can take a more sanguine outlook, and I hope I can convince you of that. But let's first look at where we are in terms of the economy. And there's no doubt that the manufacturing sector has been struggling, really bumping along pretty flat. A lot of the data looked as though it was improving at the end of last year. And when we were thinking about China in January, February, our view then was that actually things would do fairly well in the first half, and then slow, and then they would have to do something to stimulate the economy. But what we can see now, and we had to wait a couple of months to get past the Chinese New Year, what we can see now is that the economy has been slowing further in recent months. Data is up and down a bit, but overall it's slowing. But you can see that the services PMI is still doing okay. And it's important to recognize that China is still moving along at a decent rate, just a lot slower than before, and there's a big question about the outlook. Here's some more data. Producer confidence and the inventory cycle outlook. Again, looked as though they were improving at the end of last year, turned down in recent months. And if you look at electricity and railway freight, which a lot of people use to try to get past the data problems, again, it looks a little bit weaker recently. Something also that has surprised us in the last couple of months is the weakness in the housing market. And it's fairly pervasive. Again, housing was weak about 18 months ago, and then it started to improve, and actually 2013 was a pretty good year for sales and for the developers. And things have really slowed down quite a bit recently. This shows the new starts and the floor space sold quite a lot weaker. And we make a calculation of what's happening to inventory in the different cities, and you can see it's increased, again, quite a bit just in the last 3 or 4 months. And this is something that's got to be worked through. I'm not saying this is a disaster at all. I'm simply saying we have a bit of a cyclical weakness in the housing sector, which is really coming from the tight credit, I think, primarily. When you look at investment growth, obviously extremely strong after the global financial crisis, when the government deliberately stimulated it, encouraging the local governments to use the local government investment vehicles to invest, encouraging the state banks to lend to the state enterprises. So you got very, very rapid rates of growth of fixed asset investment. It's slowed, but if you look at the infrastructure side, that had gone to negative territory. It's picked up. And of course, what I'm going to argue is that one of the ways that the government will keep growth going is selectively using infrastructure investment, particularly in the inland parts of the country where they need the infrastructure most, to keep things rolling along. But it's not all bad news. Income and consumption are holding up reasonably well. Quite a bit of the drop in consumption expenditure last year had to do with the tightening up on officials. reducing spending on banquets and on gifts and so on. That seems to have leveled off now. We seem to have had that kind of one-off adjustment. And disposable income is still growing, retail sales still growing. So this is still an economy which is rolling along at a pretty good clip. It's just nowhere near as fast as the 11% or so growth rates that we got used to. And the labor market is still pretty solid. If you look at the labor demand to supply ratio, again, it's looking good. And this, of course, is helped by the fact that the labor supply overall is not increasing anymore. There is still a flow from the rural sector into the cities, but that's slowed down as well. So it's actually much easier to deal with the labor market or to maintain a reasonable labor market than it was 15 or 20 years ago. So here's the challenge. Prior to the global financial crisis, credit was rising at about the same rate as nominal GDP. So pre-2008, debt wasn't increasing overall as a ratio. Then we had the slowdown caused by the global financial crisis. The government responded by ratcheting up credit, both in the banking sector, but more importantly, or increasingly, I should say, in the shadow sector. Got a massive growth of credit for a few years. They then reined that in, and we had that slowdown in 2011, 2012. And then they let it go a bit. Growth got too slow. Europe was in recession. Exports were particularly weak, so they let it go a bit. That helped to stabilize GDP growth. But more recently, they've kept credit pretty tight overall, and it has been slowing. But of course, it's still growing faster than nominal GDP. So you still have a rising ratio of debt to GDP. And if you look at it in terms of the actual policy, in 2011, it was rises in official rates, as well as changes in reserve requirements that were tightening policy, and that drove up market rates. More recently, they haven't changed the official rate, but they've nevertheless tightened credit, so interest rates have risen. So, when we look at leverage, and we published a big report on Asian leverage last year, trying to look at what's been happening, because we all know that it's not just China, but other countries as well in Asia. So we were trying to see which countries were particularly exposed. I think you can see China there, the light blue line, one of the biggest increases compared to pre-crisis. But other parts of Asia too, we've seen increases in debt. Of course, we also have in the developed countries, that's all government debt. And the big difference between Asia and the West, if you like, is that in the West, it's the increase in government debt associated with the recession and the big fiscal deficits. In Asia, it's an increase in a mix of mostly corporate and household debt. China's debt is mostly in the corporate sector. We think government debt is somewhere around the 70–75% of GDP, which is fairly high, but if you're growing at 7%, add a bit of inflation, that's reasonably manageable, we think. And in fact, we think China has fiscal capacity to deal with some of the problems in the corporate sector. But you can see the blue line, the blue bar there, there's not all that much household debt. And when you worry about the housing sector, if you do, it's not the households to worry about. There isn't that much mortgage debt out there. And most property is mortgaged on quite a low loan-to-value ratio. The problem is more the developer debt, and more broadly, the state enterprises. I don't expect you to absorb this in half a minute, but what I would like to emphasize here is that it's very much the corporate sector in China. That second column, you see all that red in the corporate block there. Other countries have certain problems. In India, for example, there's an issue with the listed company corporates. In Malaysia, Singapore, Thailand to some extent, there's an issue with household debt. But no doubt the biggest problem or biggest issue in Asia is corporate debt in China. So they recognize they need to deleverage, or at least stop further leverage. Question is, how do you do that? So they've been trying to slow credit growth, but of course that's slowing the economy. So how are they going to balance that? They're going to get bankruptcies and write-offs. That would be good news. And we've seen a little bit of that rather selectively. That, of course, is going to create some issues in the system. and that'll probably require some recapitalization of some of the smaller banks. Again, they have the fiscal capacity to do that, so I'm not too concerned. And as I mentioned, it is mostly debt from state banks to state enterprises. So the risk of some kind of domino effect, some kind of financial crisis domino effect, I think is fairly limited. But more importantly, I think what they want to do is to open up new opportunities for investment and for improving efficiency. And there's a whole slew of reforms proposed, as you know. Manuel put up a list of the reforms in Mexico. I think the list they are suggesting for China is even longer, and they have started on those, but there is a very ambitious agenda. Most importantly, in my view, is opening up the service sector to private investment. And what goes on there is it's partly proscription, which makes it difficult to invest in certain areas. But very often it is that the sector is dominated by a state enterprise, and through the various webs of connections, it's actually very difficult to get in there for the private sector. So government needs to pull some of those state enterprises out, to divest some of the businesses, to leave scope for the private sector. And we're optimistic that they do plan to do that, but it's a huge country. Conditions differ a lot. Edicts from Beijing don't necessarily get onto the ground. So one of the ways that the government, central government, can try and force that, well, there's two ways in particular. One is to actually really tighten the budget constraint so that companies have no choice but to divest. The other is to actually encourage them to divest in a way that we sometimes saw in Eastern Europe. So the insiders gain, so therefore they have an incentive to go with it. And that may not be the ideal outcome, but at least it will take things into the private sector. Financial reform is already well underway. Most interest rates have already been liberalized. It's primarily deposit rates that they still need to do. And we think that they will also liberalize the capital account over the next few years so that by 2020 it will be essentially open. Land reform, again, very important to get better use of land and also for social reasons. Farmers hate their land to be stolen and then sold to a developer at a big profit. So that's a big social issue. Another way to deal with too much debt, of course, is a bit of inflation. And I wouldn't rule that out going forward. There's not much inflation in the system at the moment, but I wouldn't rule that out. And finally, I think keeping growth going. I see China in a way as kind of like a bicycle. You're riding a bicycle. If you stop pedaling and if the bicycle stops, it's going to fall over. So they do need to keep that going because otherwise there's going to be more of a problem with the bad debt. And of course, if you have zero growth, then why would you need to invest? So the overinvestment problem gets worse. State enterprise reform is going to come, but we think it'll come fairly slowly. This left-hand chart shows the return on assets. You can see how much higher it is outside the state enterprises, particularly in recent years. And one of the plans is to increase the dividends from state enterprises and to get that into the central government to spend on more social spending, which would also have the benefit then of, presumably over time, reducing the household savings rate, as well as taking those excess corporate savings and getting them into spending. So this is what's happening at the moment. You can see social spending up at about 700 trillion. SOE dividends are fairly small in relation to that. There's a big potential to increase them. But at the moment, very little of that goes into social spending. Quite a bit gets recycled to weak enterprises. So there's a lot that can be done there, and there's a very active debate right now in China about how to push that forward. Now, I want to address this issue of overinvestment. There is too much overinvestment, too much investment, particularly in some of the heavier sectors and some of the sectors related to construction, cement, steel, glass, for example. But I think you have to get that into perspective. And there's 2 points I would make. This is the first point. First of all, China still needs a lot more investment. And you know, when I travel to most emerging markets, I can't think of another one that has China's problem. Almost every other emerging country, I would say, growth is held back by infrastructure problems. If you're in India, Indonesia, Brazil, infrastructure is the problem. So China has a big advantage still in being ahead on the infrastructure side, particularly on the coasts, but it's still well behind when you go inland. And one of the things they're doing now is trying to direct the infrastructure investment inland to try to take advantage of the lower wages there for business and also the availability of the labor force. So you can see that even at PPP basis, China's capital stock is tiny compared to the US and still below 1930 levels. The other point I would make, and this comes back to the statistics, according to the statistics, investment is close to 50% of GDP, but that's almost certainly exaggerated. And we think it's probably closer to 40%, which is still too high, admittedly. But if you think of it as 40% rather than 50%, it doesn't sound like such a big threat. Now, how do we get there? The reason is that household income and consumption is underestimated. They don't take into account, for example, imputed rent, so the benefits you get from living in your own house, which in the US is worth about 6% of GDP, so that's not accounted for. And then there's a lot of income that people in state enterprises and the government receive in the form of cheap housing or cars or other benefits that is simply not counted as consumption. So when you make that adjustment, and that's the right-hand chart, household consumption comes up from the official figure of just over 35% up to about 50%. And if household consumption is 50%, investment can't be 50%. So we think it's probably closer to 40%. As I said, still too high, but to adjust down from 40 to somewhere in the low 30s, which is probably where ideally they would be, is a lot easier, I would say, than coming down from 50. Okay, so what can go wrong? And I think there's two things people particularly worry about. There's the financial crisis argument. And I've already said that the borrowers and the lenders are mostly state-owned. Not entirely, but a big chunk of it is. So this is really arguably a fiscal issue, not so much a kind of domino risk. And of course you have the massive foreign exchange reserves, so you don't have Thailand's situation in 1997. Thailand actually looks quite a bit like China in the late 80s, early 90s. People tend to forget that Thailand grew at about 10% per year for a dozen years, had a massive boom, but it also had much lower foreign exchange reserves. It had a very large current account deficit. So it had those external vulnerabilities, which China doesn't have. I think the bigger risk is the investment side. We've seen a number of countries kind of hit a wall with investment where you invest for a while. Brazil's another example in the 70s, Russia, Japan in 1990. And if you overinvest, and in particular if you don't have the flexibility in the economy to find new ways to invest, Japan had built massive excess manufacturing capacity, but they hadn't liberalized the services sector, so investment couldn't go there. So the issue in China is, can they open up new places to invest fast enough to allow for the fact that they don't need to invest so much in heavy industry? And that's where the reforms come in. One of the issues here is that quite a few of these reforms are probably going to be growth negative short term. If you actually restrain the state enterprises to allow scope for the private enterprises, will the private enterprises step up fast enough? Will they be able to step up fast enough? Will they be able to get the credit? So then you've got to reform the banks. But getting this all done in a short time period is difficult. As Manuel said, for Mexico, reforms take time to have effect. So where we come out is that it's not really a surprise that China has slowed down to around the 7% rate. What this chart shows is the performance of the other East Asian countries that develop rapidly. They all went through that period of very rapid growth, 7, 8, 9, 10% for a few years in the early stages of development, the takeoff stage, the low-income stage. And then they reached a level you can do these numbers different ways, but around about $10,000 on the per capita, on the PPP per capita level, and you're into the kind of middle income range, and then things start to slow. All these East Asian countries managed to get through there and get to a high level of income. A lot of other countries got stuck and went down to a very slow rate of increase, like a Thailand, for example. We think that China can follow these other East Asian countries. And that's, I guess, the big debate. But It's much bigger, obviously, than most of them. It faces a more difficult environment in the sense that relying on exports is not really possible because it's so large now. So it really can't develop purely on exports. And it's already played the heavy investment card. So it really does have to emphasize the reforms, the improved efficiencies, the opening up new sectors, and so on. Just shift gear briefly and talk about the renminbi, because I think people might be interested in our view on this. It's been quite a surprise, obviously, what's happened over the last couple of months, well, it wasn't a surprise that they widened the band. That was expected. What was a surprise was that they've allowed such a big move down. Our view remains that this is temporary. This is not a response to the weak economy so much, although that may be a little bit of an element in it. We see it much more as trying to prevent the excessive inflows, the excessive speculation that they saw, trying to create really a two-way street. Having a two-way street in the exchange rate is going to be very important if you are going to liberalize deposit rates. Otherwise, money will just keep coming in because liberalizing deposit rates mean they go up. So they needed to do this. We think it's going to be a temporary phase, that you'll see volatility. You could still see further weakness. But that in the longer term, it's going to come back. The trend is still going to come back. We expect the current account surplus to increase. We expect that the reforms will encourage some inflow. And as I say, we are expecting that the effective deposit rates that people can get will increase. So here's our forecasts. These are for the official GDP growth. So 7.4 this year, 7%. And as I indicated with the dot chart, we'll see a gradual further decline in growth rate in China over the next 10, 15 years, eventually probably going below 5% by the late 2020s. Partly demographics, but more importantly, they'll be moving through that middle income level and getting to a point where naturally you grow more slowly. Inflation, not a problem. Base savings rate fixed. You can see the current account surplus increasing somewhat and the exchange rate resuming its appreciation. And do read this carefully. Thank you very much.
All right. Oops. Questions from the audience? We have one over here. Jill?
Thank you. I'm Fabrice Montagnier from Barclays. A question on China, and especially very, very pragmatic. How do you use FX reserves to stabilize the banking sector? I mean, at one point, do you sell your dollars or your euros, or how does it work in practice?
Yeah, I'm not particularly saying that they use the reserves to do that. What I'm saying is that they have a fiscal position which gives them the scope to do that if they want. And because you're very unlikely to see some kind of domino effect where people are reluctant to put money in banks or big sell-off in the market because they see it as ultimately guaranteed by the state, then the risk of that, I think, is quite low. But the point about the reserves is that you don't have the risk of a big devaluation suddenly, that they can control it in a way that Thailand couldn't. And that's important because there has been a build-up of external debt. It's not huge compared to the size of the banking system, but nevertheless there is a greater vulnerability now should you see a big devaluation. And I think, again, one of the reasons for allowing the two-way move is to emphasize to people that it's not a one-way bet. So again, that's trying to give themselves that extra flexibility and kind of introduce risk into the system, but it's the fiscal strength they have rather than the reserves as such that they would use to support the banking system.
George Chechos,
Yes,
Chairman of GIC. I'm
yes,
just pointing out.
thank you. I have actually a question for Manuel and a question for Koso. So what is the vulnerability of the Latin American economies to the prospect of increasing interest rates in US? And I think you alluded to that. You said it's our problem, your problem, whatever it is. But do you have any specific ideas as we are moving to an increasing interest rate environment? And then I have another question for Koos.
Depends. Typical answer from an economist. Now, it depends on the rate of increase, right? Pretty much if the rate of increase of interest rates in the US is moderate, piecemeal, slow, over time, blah, blah, it will not have a dramatic impact. It will not have a dramatic impact beyond what it already is discounted, which it is, and beyond the domestic conditions or domestic factors will dominate over the interest rates. However, if we have shocks, if we have surprises in interest rates expectations, you don't need them to change. You just need expectations to change. You will have you could have an important impact in Latin America. In particular, you could have an important impact in Brazil, right? In Brazil, you might have a shock regardless, particularly on the exchange rate once elections are over, right? So if that's added, if all the uncertainty is cumulative to uncertainty in the US raising rates, they will have a problem. They will respond raising rates as well. The problem with Brazil is that people are exiting Brazil not because of low rates, but because of other factors, right? It will have a lower impact on countries like Colombia or Mexico, although they will also have to respond by maintaining the spread. So they are likely to raise rates as well. As a matter of fact, Colombia already has risen rates because of their own domestic factors. So they will not be, that's not going to be the dominant factor. In the case of Brazil, I'm worried, and it will matter, if flows continue to exit, piecemeal as they are, by the time the US raises rates or rates are risen, it won't be too large. It's going to be much more important if it's a real shock. It will affect much more Brazil and Mexico, right, than the rest.
And for Kozo, I think you presented some interesting statistics, and one number that is in my mind, in the corporate sector, you reported that almost 48% of sales is on the balance sheet as cash. So this is a huge number. And all of us know that eventually this needs to be converted to productive investments. And the question is, why up to now we haven't seen a substantial, investment program or capital expenditure substantial to create a condition in which, of course, those balances are going to be utilized better on one hand, on the other hand, to stimulate more the economy. So why not? I mean, that's the question.
So I may say that is Japanese conundrum. One of the part of the growth package released the last June is we just follow the so-called stewardship code here in the United Kingdom to harness the level of the corporate governance. I am a banker. Before I joined the asset management firm about 10 years ago, I was a banker. At that time, the 25% outstanding share was held by the Japanese banks. So therefore, there's a traditional cross-shareholdings, but on the bank has a very long-term view to support the companies. But these days, the shares go down below 5, and about the 25% equity outstanding was grabbed by the foreign investors. But maybe the weak governance of the efficient use of the capital is still quite weak, so therefore we should do something. But please remember, under the long-lasting deflation, to just hold a huge cash balance makes sense. Theoretically, you just sit on the cash balance, purchasing power automatically grew under the sustainable moderate deflation. And also, it is not a scientific answer, but this is my image that in the last 2 years, the current board members has been promoted under the deflation suffered by the huge shock inside outside. So therefore, they not get used to take the risk, how to take the risk. And also, in the economics forecast industry, I am old enough to talk about the flavor of inflation. I was a lending officer at the bank in the late 1980s. But for example, my daughter born in 1991, she never ever experienced inflation. So therefore, she could not understand what inflation is all about. So therefore, the economists, they actively just making a focus in Tokyo did never ever experience the inflation besides the number on the paper. So therefore, let me just conclude my remark in short. I recommend you not to rely on the macro model, or what shall I say, quantitative model this time around, not only to make a focus of the GDP number, but also the risk premium on the asset market, because all of the model was constructed by the, in the last 1 or 2 decades time, deflated number. When I started The Economist in 1998 and 1992, I hit the mark in the forecast contest in 1993. At that time, the average number of the forecast at 2.8%. But in reality, that year was the first year for the Japanese economy to go dive into the negative territory for the first time since the past oil crisis. This time, consensus view is including the 5.5 supplemental budget action taken by the Abe government. 0.7, 0.8 is the Japanese consensus. And if you just delete the fiscal policy package impact, only 0.1 to 0.2 is the answer from the consensus forecast of the Japanese economists. But that's wrong. And also the Nikkei's models, one of the most well-organized macro model, but also they says that without no supplemental budget, this year's growth rate is only 0.1. So therefore, I strongly recommend you to respect me because I'm old enough. So therefore, there is some dynamic, not non-linear differences between the two words. And you cannot imagine how is the taste of the deflation if you are not the Japanese. Thank you.
Hi, question for John at the end there. Just on the China, you talked about, well, you touched upon the twin excesses, mainly like, a lot of excessive debt fueling excessive investments, and you talked about the reining in of the excessive debt. Just on the investment side, I wanted to just hear your thoughts on some of the investments that are really, there's some coming through which are saying that's unproductive to GDP or accretive at this stage. Could you expand on your thoughts on that?
Yes, I mean, I think the issue really is overcapacity. Is there too much overcapacity? That's your question, is it? Yeah. So this has been generated partly because of the nature of the way China works. It's kind of an agglomeration of Singapores, it's one way of thinking about it. So you have all these individual cities and sometimes provinces where sort of they cheerlead the local companies and often help set them up. And then they're set up in competition with others in other areas. So you end up with a steel plant in every place and an automotive plant in every place. And then you're trying to reach a particular GDP target for your area, so investment's the easiest way to do that. So there's been a tremendous sort of structural incentive to maximize investment and take no account of actual profitability. And that worked well when you had growth running at 10 or 11%, because very often, that capacity a few years later could be used. If you look back at what people were writing, for example, 6 or 7 years ago, before the crisis, like 7 or 8 years ago, they thought there'd be massive overcapacity in the automotive industry. Well, actually, not really, because the demand has increased massively, and China now makes more cars and consumes more cars than the US. So as long as the whole thing kept going, and this is my bicycle analogy, you were able to absorb that. But what we have seen, obviously, is a slowdown, and right now we're seeing a cyclical slowdown in housing, which is just starting, and yet we have all this capacity. Back in 2007, a bit of capacity developed, and to some extent it was diverted abroad. And there was a big rise in exports from China, and China actually had quite a bit of growth from net exports in those 2 or 3 years. Much more difficult to do that now, partly because China's so much bigger, so this would be a much bigger chunk of the world, but also because the world isn't growing that quickly. So how do they deal with that? And the answer's got to be that they have to stop investing in some of these areas, and in some cases they may need to dump existing capacity where it's not efficient or where it's too old. So that's one big area. In the construction sector itself, there's a lot of talk about ghost cities, and we've looked into that. There are areas where they've built massive blocks of flats and nobody's moved in, no question. And in many cases, in some of those cases, they're not sold. But in other cases, there are a lot of empty flats which have been sold. So people in China buy an apartment rather than you might buy land in the West. It's just something to hold because you get such a low deposit rate from the bank. And those apartments are empty. And when I say empty, they usually won't have floors or doors or kitchens or bathrooms because apartments are not built with those initially, and you put them in them yourself. So there's no point in putting it in if you're going to hold the place empty because fashions will have changed in a few years' time. Be carpets, not hardwood or whatever. So that's why people talk about these see-through buildings where there's no lights on and nothing happening. But in many cases, they are sold. They're just being held as investments. Now, you might argue that's not a particularly good thing, but most of those have been bought with cash. They are a way of holding cash, if you like, holding wealth. And the chances of people trying to sell at once or some kind of distress coming out of that is quite low. So I think, and just to conclude that thought, one of the reasons that the housing market has suddenly slowed recently is simply expectations. People don't expect prices to rise, so they're not buying. Prices are now falling. At some point, they'll fall to the point where people actually feel it's maybe time to buy again. So it's kind of a short-term cycle. So long story short, a lot of the heavy industry overcapacity means that you're not going to get massive new investment in that area. So you've got to have it somewhere else. And then it's a question of can you open up enough new sectors, particularly for the private sector to invest, but maybe also some state enterprises. And there I'm quite optimistic because China really is a nation of entrepreneurs. I think a lot of potential investment is actually held back because people can't get into those sectors. You can only, in many areas, you can only get in if you can find a niche that the state enterprises will let you into. But to the extent that the central government can rein those state enterprises back and allow that space, and to the extent that you can find the resources to invest, and there is a lot of cash and there is a lot of wealth in China, so even if it doesn't come from the banking system, there are ways to find it. I think we will see that. It's just that in the very short term, it may take some time to come through.